All right. Welcome everyone today to the third webinar in the series, and today we're going to be addressing international tax issues for athletes, which is a very complex space. With me again is Will Tuffley, who's the co-presenter of today, and I'd also like to introduce Courtney Whitecross, who's a special guest presenter. So thank you for being here today, Courtney.
Hi everyone. Thanks for being here today. Maybe if I just give some quick background. As Morgan rightly said, my name's Courtney Whitecross. I'm an Associate Director in the Corporate and International Tax team here at BDO. So if you've got any questions along the way about international tax, please feel free to raise it.
All right. Thanks, Courtney. So we might just jump right into it. Just a quick disclaimer. Now, this is a survey we actually previously ran, and it's just about how many of the respondents, how many professional athletes do play sport overseas. And you can see there that it's pretty significant that almost all professional athletes in Australia will at some point have a stint overseas, whether it's 1 year or potentially for several. But it means that this topic is very relevant and is very important.
It's becoming more relevant, I suppose, as well, just given that there's overseas events. You know, we've obviously got the Olympics coming up. You know, that's, money that's being earned overseas, and it depends how each individual sport deals with it, but there is earning capacity overseas, so it's how we deal with that, even if you're not fully based over there as well. So I thought we'd rehash back on, this is a topic that we sort of touched on in our first webinar, just around tax for athletes and just the residency requirements and how people are assessed as a resident. So the residency tests, and we are going to touch on, there's been a budget update, which we'll touch on later on in the webinar, but at the moment, you've got your sort of 4 residency tests to sort of give you an idea of whether you're a resident or a non-resident for tax purposes, and it does make a huge difference whether you're a resident or non-resident based on the income that you declare in a tax return. But the residency and versus non-resident is a huge thing. Courtney, I know I've worked with you on a couple of clients recently where we actually reviewed their residency position, and we were able to get a good result for a couple of clients, weren't we?
Yeah, it's certainly a hot topic with the ATO in particular at the moment. There's of course legislation in place, but there is a lot of case law out there, and that case law is being sort of updated all the time. So it's really important that if you are thinking about going overseas, that you do seek advice before you leave, and we'll go into that in more detail. But yeah, certainly there are avenues that you can take to solidify your residency or not, whichever one you're looking to apply.
And there can be some big dollar figures, even just for an individual. I think the case that we had, we were able to get almost $90,000 back for the client, just based on purely on their residency. And just making sure that the residency was dealt with correctly, which is a pretty significant amount for an individual client. So yeah, it is really important.
And the big takeaway for me, and Courtney said it as well, that there are a few tests and they might appear black and white on face value, but a lot of it can be subjective. And so yeah, it's really important to get advice in this space, and not just once you're overseas, but well in advance. Make sure you've lined up all your ducks with your accountant, so you are doing the right thing and don't have to pay tax where you don't need to.
And this was just a scenario that we put up last time, so I won't go into it in too much detail again, but it's just a good example of the type of circumstances that individuals can be in. And even though these ones are reasonably similar, the differences in their residency status, there's a difference in their residency status. So it's really important to make sure we're looking at the facts, but also doing the things and checking lists and bits and pieces and doing your things here to make sure that you're not either taxed in both countries or getting the best tax outcome based on, and not just from a formality that you weren't able to approach your VA back in Australia. So as we said, recent federal government, recent budget, there was some new rules that were proposed. And these potentially are not going to be brought in until 1 July 2022 at the earliest. But basically, they've said they're trying to simplify the test, which they sort of have, but as a result of simplifying it, it's probably going to capture more people as residents than non-residents. So again, as Courtney said, it's really important to get advice and look at your personal situation before either, whether it's getting into investments or going overseas and earning income overseas. It's really important to get that advice because this is going to capture a lot of people and it's not just as simple as where you're living. So again, make sure that you're getting the advice. I won't go too much into detail with these new rules, but from a very basic point of view, if you're going to be in Australia for 183 days, so more than 50% of the year in a tax year, they're basically going to say you're a resident for tax purposes straight up. If you're under that days test, that doesn't mean you won't be a resident, but they're going to then look at these secondary tests. And that will depend on whether you're ceasing your residency or commencing your residency. So again, there's some really I suppose we're saying they're probably tough. There's a couple of ones here where you can be overseas for 2 or 3 years and they can still say that you're a resident based on these current rules. So it is really important to get that advice and make sure everything's in line.
Yeah, and I mean, the big takeaway for me is that the rules change. It's a new set of rules. They've changed in the past and we'll keep seeing tweaks to the legislation over time as well. So it's important to be in contact with your professional advisors, because what you're doing now might not actually be the best thing for you in the future based on the changes coming through.
Yeah, and I think the federal, like these rules, I think did need a bit of an overhaul. They haven't always been grey. It's been a grey area. But I think the takeaways, they have, I suppose not accidentally, but they have captured probably a few more people than they are intending to. So that's where the feedback's going back to them at the moment. So anyway, we'll see where that comes in, and if you need any assistance with that, if that's going to be capture you got anyone at any stage, then just get in contact with your accountant or your advisor and have a chat to them, because it is going to be really important.
And maybe just to touch on that previous client that we had too, plans do change. So even if you do seek advice before you go, things can always change. Look at COVID, people that maybe thought they were going to come back to Australia actually haven't come back to Australia, or they can't for whatever reason. So make sure that if your plans do change, you seek advice about that, because you might end up actually being in a better position.
Yeah, no, absolutely, and especially documenting it all, right? So that's going to be a really important thing when they come and get it, come for you.
Yes.
So why does this matter? So I suppose the big thing is the tax rate. So Australia does tend to be in a higher tax environment than a lot of other countries. I think I was looking up the other day, it was about the 24th highest.
Yeah. It's up there.
Yeah, it is up there. So, but not only that, if you're a foreign resident here in Australia, you get taxed at a high rate. So you don't get any tax-free threshold, and the stagger is not as good, I suppose. So you sort of tax at 32.5 from the get-go, all the way up to 120. So there is a higher tax environment as a non-resident, but that's obviously only on Australian sourced income. So there are benefits in being a resident on your Australian sourced income, but again, it's going to totally depend on your individual situation. But that's why it does matter to determine whether you are a resident or non-resident from a taxable income standpoint.
It's good in Australia to some extent that you can earn free money to a point, but then you start paying tax, whereas you can't earn any free money as a non-resident. So yeah, it's important to get that right.
Yeah, absolutely. And then in terms of the actual income that you're assessed on, so a resident, you have to declare all your income worldwide. So whether you're earning it here in Australia, whether you're earning it overseas, it has to be assessed. So if you are a resident for tax purposes and you're earning some income overseas, that's, and given that we are at a high tax environment, that's why it's important to sort of make that assessment. Because if we look at the assessment and you end up being a foreign resident, there could be a lot of income that you don't actually have to declare here in Australia. So it is really important to get that right. If you do get taxed on income overseas, you can get a credit for it. It won't be refundable, so you can only get up to the limit of how much you pay, and then there is a foreign income tax offset that you need to apply for. If it's over $1,000, there may be some limits, and there are restrictions on it potentially based on your circumstances. So again, get the advice on that, but you do get the credit back for it,
Yes.
assuming there's a double tax agreement in place, which we'll go into a little bit further as well. For a foreign resident, all the income here in Australia, the only income that you don't have to declare is Australian sourced interest, dividends and royalties. Now that is on the assumption that tax is being withheld on them as well, which if you've got the correct things in place, they should be. So franked dividends would be you don't have to actually declare them here in Australia, but unfranked dividends you would. And then interest, usually you have your foreign withholding on them on your bank accounts. When you let your bank know that you're going overseas or you're going to become a non-resident, they then start withholding on it, so you don't have to declare the interest here in tax returns here in Australia. So yeah, there are a few things that foreign residents don't get taxed on, but effectively, I mean, in a nutshell, they do get taxed on it. It's just that it doesn't mean they have to lodge a tax return, which is more of a compliance point and thing. So yeah, so that's sort of the big differences between the two. As I said, tax treaty, there's a fair bit of detail in here, but effectively the DTA, so the double tax agreement. So Australia has agreed formal agreements with I think it's 40 other countries at the moment, and that's just basically to prevent tax being paid in both jurisdictions and with the international tax authorities. So what they do is that, again, they just reduce you and eliminate double taxation. They provide a level of security with tax rules, and they prevent avoidance and evasion of taxes. There is tax relief in these rules, and they're ever increasing as well. So I think there's a couple more that have just come out recently with a couple other countries. So, and it just allows you to claim that foreign income tax offset if you are assessed on income overseas. So yeah, Courtney, I don't know if there's anything further to add from there, but that is, again, an ongoing thing, right? There's always a DTA.
There's always DTA, and they are updating DTAs. So just make sure that you're looking at the most current one, really, when you're having a look at it, or getting your advisor to have a look at it.
To make sure, yeah, because it isn't just you're paying tax overseas, sweet, I can get that credit straight away. It doesn't always work like that. It's not as clean cut. So yeah, it does depend on which country you're earning that income. So make sure you're doing a bit of getting your advisor to research that. Tax structures. So I thought this was a really important one, just in terms of what actually happens if you were to, the residency was supposed to change. It was going to change if you in your personal situation, and whether you're a sole trader, company, or a trust. So sole traders, partnerships, it's purely based on the individual residency, so same test as before. Companies, it depends on whether they're incorporated in Australia or they carry the business in Australia, or where that central control and management is, which is a really big one. It's something that probably isn't looked at a lot, but basically the decision making and the actual business is effectively being run here from Australia. Then it's looked at that the company is an Australian company. Correct. So that's really important. And then from a compliance point of view, 50% or more of the directors must be tax residents. So again, that's probably a bit of a one that where if circumstances change, it's the compliance of the company that all of a sudden becomes an issue.
That's a big one for me too, just as a financial planner. For people who might have self-managed super funds looking to buy property through the fund, say you and your partner have set that up, and then for whatever reason you decide to go overseas and pursue your career overseas, then you have to be in Australia if you have that self-managed super fund, because that's where the central management and control is. If you leave, that stuffs up the whole fund. It becomes non-compliant. There can be all sorts of penalties. So having that forward planning to make sure that if you are going to move overseas, you've prepared for that and your fund can remain compliant even when you leave.
And it doesn't even have to be self-managed super funds. If you go, and I'll go into this example, I think that's a good lead on into this example actually. So, if client had a commercial investment property, what would happen if your residency does change? So in your personal name, straight away you're a non-resident. So yes, the property can stay here, but you're going to be taxed as a foreign resident on that income. A company, let's just say you are the only director. All of a sudden, you're a non-resident director. That company's non-compliant based under the rules. So things you might have to add a director who's an Australian resident. But even then, you still have to look at the central management and control has to be done here. So there's a few complications there. And then a trust, depending on who the trustee is. If it's a company, again, exactly the same situation. We have to make sure the company is an Australian company. And then if it's an individual, maybe we have to change that trustee before you go overseas. So that's a really, really important one. And again, as you touched on, Morgan, with a self-managed super fund, it gets a bit more complicated because it's not actually based on the members who are the non-residents. It's based on the members' balances. So if 50% of the balance of that self-managed super fund is owned by non-residents, then it's all of a sudden non-compliant. So it gets, again, real muddled and real confusing. We've had a few clients who have been keen to set up self-managed super funds, but in the background, we knew that they were potentially going overseas. So we've sort of said that's fine if you wanted to do that, but you have to understand if you're going overseas, that it could be an issue, or you might have to shut down the fund. So it wasn't worth the time or the money. They were better off building the wealth while they're over there, and then once they come back to Australia, that's maybe the time to do it. So.
Yeah, I think, and again, just stressing the forward planning, but Australia is a great country to invest in. We're well regulated. There can be higher rates of tax, but if you are going to go overseas and you don't know if you're going to be coming back or not, you really need to be decisive about what you're going to do, whether you start buying assets and building your wealth in Australia, or if you're doing it in the country you ultimately end up in, because there can be implications of trying to change things after the fact. We can all buy assets, we can all set up structures, but doing it wrong from the start can be very costly to unwind, especially from a tax point of view, transactional point of view. So that forward planning piece is just so important.
Yeah, absolutely. And it's ongoing, right? So it's not just yes, it's from the start, but then it's, as you said, circumstances change. So it's really important to make sure that we're always looking at it. And I suppose even when we're not going overseas, it's just the circumstances change, right? What we have to look at, it could be, you could be getting married. So all of a sudden you've got a partner involved. How do we restructure? Is it important to restructure? Baby's on the way. Morgan, you and me both. We all are now, aren't we? We're all in that situation. So making sure that, that's everything's in place. So
yeah, COVID's the biggest curveball too, because you go overseas, you might never come back even if you want to, and that changes things.
Yeah, absolutely. Well, my brother's in that situation. He's sort of, he went over there. They probably, I imagine potentially that he would have been back with his wife by now, but COVID sort of changed things, and he's in a different situation. So even from his circumstances, he's going to be pushing out beyond sort of that 6-year period, which we'll actually talk about that actually makes a big difference later on. So yeah, absolutely, some really big examples of that.
Everything just seems to come back to get advice and document it.
Yeah, pretty much.
Make sure your assets
This
are
whole
covered.
thing.
That's right. Another one that I thought would be really good to touch on was Forex gains and losses, and just the bank accounts that we set up. So basically, foreign currency gains and losses are taxable. So that could be purely just buying and selling foreign currency. It could be trading currency or ceasing to have the right of it, paying foreign currency. There's a few other, gains, but the nuts and bolts of it is if you're buying and selling foreign currency, you have to pay tax on we have to pay the gains or losses are assessable. And I suppose why this is really important, and this sort of ties into the bank accounts, it can be really costly dealing with foreign income and foreign expenses overseas. So, we've had plenty of examples where we've had clients who they earn money overseas, and it might come, they haven't set anything up, so the money comes directly back into their Australian bank account. So straight away they're probably going to be hit with foreign fees from the overseas provider, and then they're paying for all the expenses over there as well, so they're getting double hit with it. So not only are they getting probably hit with it, and the timing could be bad, so the foreign income that they earn, that could be really bad conversion rate in Australia just at that point in time when it gets hit. So they sort of get a double whammy of
you could be paying a few percent in fees every single transaction.
Yeah, exactly. So it's really important to have a proper bank account set up. So we'll put some examples there of HSBC and Citibank, but there's plenty out there. to get set up. It's not necessary, and that can just be a multi-currency account. That's a really easy thing to set up. It can be a bit tougher if it's a company or a trust, but we definitely have some ways around that and can put some things in place to make that easier. But I just think doing a bit of research, putting a bit of effort into setting up an account overseas is really, really important. It can save you a bucket load of money. And especially that paying for expenses overseas. If you're an athlete and you're earning income over there and then you need to pay expenses over there, that's where it starts adding up, because you're getting hit on a charge on every single time you pay for something or that cost. So that's where it's really important to get that set up. And then when you actually bring the money back is using a provider who does the currency conversion. Again, there's some good ones out there. There's a couple of examples there that I know that we've worked with, but there's plenty out there. And it's becoming a bit of a competitive market to get a good rate there. It's a bit like brokering stuff now, isn't it? It's the same sort of thing. So really important to get that, and you can cut down on fees and avoid potential losses. So
I think as well, we've seen some pretty major currency movements in recent times, especially through COVID. The Australian dollar got down to, I think, something around 54 US cents. Now it's closer to 75 US cents. So depending on when you're moving currency between those two currencies, that can have a huge difference as to how much you ultimately end up with. So it's a really important consideration, not just what's the cheapest way to get it across, but what part of the market cycle are we in?
Yeah, absolutely. And I think that's a benefit of one of those multi-currency accounts as well, is you can keep it in that, you might earn it overseas in Euro or US or whatever it is, and it might be at a time when the Australian dollar is killing it. So if you bring it back, you're not going to get as much Australian dollar as you otherwise would have. So it's really important. I just think it's such a beneficial tool to be able to go, you know what, I'm not going to bring it back yet. I know I'm going back to Europe or I'm going back to the US to compete over there anyway. Why don't I just leave the money in that account until I go back over there, and then all the expenses that you start using over there, you can then spend over there. So I think it's a really good tool to not only cut down on costs, but get the most out of the money that you're earning. So yeah, really important. I think that's a really important one that probably gets lost a little bit and not thought about. And I think we're always going to be in a situation where if you're earning money overseas, this is going to be so relevant. So
absolutely, that's what I find too in my experience. It's been that people just don't think about the Forex gains and losses. They think about lots of other things, residency, like we've touched on, but that foreign currency, as Morgan said, like it really does can fluctuate a lot, and it can make a big difference, especially if you're so maybe you bought a property in the US and then you go and sell it at a later period of time. You've got to think about that possible FX gain or loss when you do go to sell.
Yeah, and the timing difference it made, because especially with something with settlement.
Settlement period
can make a huge. Yeah, if you'd had settlement in that COVID period, like the Australian dollar changed so much, like it could have made a massive difference. So
well, you think like it did get down to around that 54 cent mark. At 75 cents now, that's almost 50% higher the Australian dollar. So
big money, big difference. So property consideration, this is one that Morgan gets excited about. So just from a capital gains point of view, if you're a non-resident and you're selling your property overseas, you're probably going to be liable for the full CGT with no discount. So it's really important to have consideration if you own property here in Australia and you are intending to go overseas, putting some plans in place and making sure that the timing of things is correct. So effectively, if you have a main residence here in Australia, it's exempt from CGT. And I'm assuming it's got a dwelling on it and you've been living in it. But if you leave your home and you continue to treat it, you can actually treat it as your main residence for up to 6 years while renting it out, as long as you don't have a main residence anywhere else in the world. And if you don't rent it out, you can actually treat it as your main residence for an unlimited period, as long as you don't have another one. So where this is beneficial is if you here in Australia, you get investment property as an athlete, you put your hard-earned income to that, bought a house, and then you get an opportunity to go and, you know, compete overseas, which could be indefinitely. It allows you to earn income on that property or negatively gear that property back here in Australia while you're over there. And if you end up coming back within that 6-year period, you know, you'll still not pay capital gains tax on that property.
So your brother must desperately want to get back.
Well, yeah, that's exactly the point. And again, like, perfect example of where he's now going to be in a situation where they're, you know, and look, there's in the scheme of things, if he came back not within that 6-year period, and maybe it was 7 years, there's still only potentially, if they move back into that property, potentially it's only 1 year out of the full life of that property that they're going to have to pay tax on. But again, good example of, you know, this is actually a really good tool to have, and a lot of people aren't wary of it. But again, as we talk about getting the advice, there's a couple of important things that you have to do in order to meet this, but also it's around timing. If you feel that you want to sell the property before you leave, it could be really good to make sure you're doing that before you leave, because if you end up doing it while you're over there, straight away, you're potentially paying full capital gains tax on the whole property with no exemption. So
then you think you lose a 50% CGT discount, that means paying twice as much tax. Like, that's a shocker.
Yeah, well, and just paying any tax at all on a property that potentially you pay no tax on, getting all the profits back in your account with no tax, it's a huge and significant difference. So I think it's really important, again, documentation, timing. Even if you don't necessarily know what you're going to do, I think it's around, you know, getting prepared. So getting market valuations at the time you leave gives you options to how you then.
You can make an informed decision.
That's right. Yeah, and you can, you know, like, there are a couple of ways you can work out if the exemption doesn't apply in full. There are a couple options you've got in terms of trying to work out, right, well, what portion of the gain do we make? So it's really important to get that information and document that information at that relevant time, because it can make a difference to the decision that you then make further down the track. And as we always talk about, you know, a lot of this residency stuff comes down to intent. So if you sort of don't know your intentions, get it documented and put it down on paper, because it can come back to be really beneficial for you at the end of the day, which is what we want to do. So I just thought we'd summarise with some key takeaways. We probably banged on about it, but documentation. So just any time during when you're overseas or you're looking at going overseas, you need to start documenting stuff. We've done a pretty comprehensive overseas checklist for when anyone's going away, and that can include just things that you've got here in Australia, whether it's memberships, registrations, bank accounts set up here, you know, your private health here, you know, all the sort of things that the ATO would look at and go, well, were you actually intending to go overseas? Because you didn't close any of these down. It looked like you were always going to come back. That can make a big difference in terms of, you know, whether the ATO decide to call you a resident or not. So as I said, we've done a big checklist and a really comprehensive one to sort of make sure you've crossed the T's and dotted the I's before you're going overseas. So if anyone wants a copy of that, please feel free to reach out. It's worthwhile and just sort of gives you the confidence that when you're going overseas, everything's in order. But also in terms of documentation, you know, as I said, if circumstances change, you know, get advice and get it down. So make sure we're setting up overseas. You know, as I said, we banged on about the accounts, so make sure they're getting set up. Getting prepared for it is really important, because it can be a huge cost saver. And lastly, get advice. You know, reviewing your structures and investments. The last thing you want to be, you know, moving overseas is stressful enough, especially if you're taking family and children with you. The last thing you want to know is that some company back here in Australia that you've sort of left behind is non-compliant, and you're just going to start getting hit with direct penalty notices. So that's just the last thing you want, when we could have put something in place that was really simple and easy to change, and you know, potentially doesn't cost you anything to change, but just needed to be actioned. So I think there's sort of 3 big takeaways from this topic. As I said, make sure you reach out if you get in this situation, and we've got plenty of tools that we can use to help you. So that was sort of all we had today. I don't know if there's any questions that have come through. Morgan, is there anything else that you thought that, from that topic you think would be worthwhile touching on?
Yeah. So foreign currency question for you. Say I'm an athlete in Australia and then I decide I'm going to go over and work in the US. It's a fairly good time to go across in terms of Australian dollars higher than it typically or historically has been over time. So a good time to transfer money over. Now I live over there for a while, decide to eventually come home, and the currency rate with the US has really moved in my favor, and so I'm bringing back 20% more in terms of the currency conversion. Is that going to be taxed, or just because I'm not a currency trader, can I get away with that and just bring it across because I'm just living my life, just moving places? What's the options?
It is, well, the answer is it is potentially.
Yeah.
So there are certain, without getting into too much detail, you can have less than $250,000 Australian dollar equivalent, and you won't actually be taxed on those foreign currency gains or losses, and there's some tweaks to that as well. But subject to not meeting those concessions, then yes, you otherwise would be taxable.
Yeah.
Do you agree with that?
Yeah. So again, depends on your circumstances, but
Yeah.
but yeah,
Assuming you're a resident,
there are some
things.
rules on how you bring that to account. So there's a couple of different ways. So applying the 250 K rule is one way you can actually apply, and potentially that might be relevant. So yeah, it does depend, but yeah, absolutely there can be some implications there. But again, I suppose looking at that, if you are taxed on it, it's probably because you have brought it back in your favour.
Yeah,
which
you've got to remember
that's a positive. That's a
there.
positive thing.
Yeah.
So we get scared about tax a lot of the time, but the reason you're probably paying tax is because you're doing something. You've earned the income. It's a positive thing. So we would much rather work with you to bring the money back, so that you do get taxed on it than not get taxed on it, because it means that you've got less money in your pocket. So
yeah, I mean, I fully agree with you. I speak to so many clients and they're hooked on negative gearing, and I just tell them that asset is costing you money. That's why you're negative gearing.
Real money. Yeah.
Whereas if you're positively geared or you're paying tax, you're making money. So I fully agree with you on that. Another question. Now this could be a bit of a curveball because this is a general podcast. There's no specific advice. So I've been overseas for 5.5 years. I've been renting out my family home. I haven't lived in a primary residence overseas, or that I own overseas. Can I nip back to Australia, see my parents, live in my house for 2 weeks, and then off I go again?
Most likely not. Yeah, again, it probably depends on what you say. So I think that's probably a good example where it comes down to, at this stage, it would come down to intent. So clearly it's a good example of where you were never intending to come home and actually reside here and live here, and then just due to circumstance you've gone back. It's just a holiday. People weren't renting it out at the time, and that's about it.
So you can't reset the 6 year.
Not that way. Definitely, if the contract had ended, you came back, you started a new contract here, and again you document that, and then all of a sudden they said, actually, you know what, we want you to go back to the UK and do it over there. And you get a brand new contract. There could be an argument for the resets on the assumption that you meet all the criteria. So yeah, there's definitely some circumstances where that's possible.
Get your documentation, hey?
Get your documentation in place, document your intent. So yeah, I think that's a good example of where people can just, and this comes down to the old pub talk sort of thing. It's like, oh yeah, you can come back, just re-trigger it, it's all good. Like that's a really good example of where there's rules and people don't look at the detail of the rules. They look at it that sort of they brush over the actual detail. That's a really good example of where you need to actually have a look at the detail about circumstances, but also it does become into that grey area of what's your intent, where's your domicile, like all those sort of things. So yeah, I think that's a good point in terms of that. Good try. Good try.
All right. Well, this has been a really good COVID-safe session today. We're all physically distanced, which is good.
Yeah,
Absolutely.
awesome. And we've got a few more topics coming in. I think that we've had a few requests from a couple of topics, so we'll be posting that up in the next couple of weeks, I'd say, about what our next topic will be in the next couple of months. And keep bringing your feedback around what sort of topics you want. This is specifically for athletes, so we want to give the advice or give the presentations that are going to give the most back to athletes. So keep providing that. It's really good, and we can make these topics really specific for what you want. So if that's it, we might wrap that up. Thanks very much for everyone who attended. Really appreciate it. Thanks to our special guest Courtney. Great to have a specialist who can provide some really good insights for us when it's clearly above me and Morgan's pay grade. So we really appreciate that, Courtney, and yeah, we look forward to seeing you guys on the next webinar.
Thank you.
No problem.
Thank you.
Thank you.